Target in Focus, we'll be taking a look at euro dollar, pound dollar and dollar yen. Joining me to discuss these currency pairs is Craig Ferguson, Director of Strategy for Antipodean Capital Management Pty Limited. Hello Craig. Considering the current high volatility within the European financial crisis, what are your short, mid and long-term predictions for the euro dollar?
You know, we're kind of starting to get towards a little bit of an endgame scenario in the euro. Clearly we had, up until now, we've had a scenario where the euro's been weakening on progressive bailouts from Ireland, Portugal, Greece, and to some degree Spain and Spain's banks. But at the same time, economic growth in the eurozone has been declining. I think during that whole phase, most of us were probably looking at it and saying, well, if it ever gets to Spain or Italy, then you get a much bigger question because those are perceived as too big to bail out. We're now getting to the point where the EU has to make a decision on that. It has to either complete the integration process that was started 12 to 15 years ago and move towards fiscal banking, which they're starting to do, but also debt unification. And in that sense, they have to completely forgive, so to speak, the peripheral nations or high-spending nations of the debts that they've previously run up, as well as those for the future. So we're kind of into the scenario now where they have that choice, or if they don't want to make a choice towards complete integration, they then have to simply sit there and allow nations to leave, such as the Greeks and others. I think what we're going to get from that scenario is continued uncertainty. I think from a data point of view, we're going to get much weaker EU growth than what we already currently have reported. So in that sense, the IFO survey, which is a good measure of German and European activity, looks like at the current 105 level, it needs to be a lot lower, somewhere down around the 90 or 95 level. And if that's the case, you're going to start to see not just quarterly declines in GDP of -2 or -3%, but you're going to get much bigger declines of -0.5 or -1%. So that means further rate cuts by the ECB, further narrowing in interest rate differentials where EU yields fall and continue to fall below those of the US, and a decline in euro eventually under the 118.80 level, which has marked the low for the last couple of years towards 110 or towards parity.
What long-term damage do you think the euro crisis will have on the euro dollar?
Yeah, clearly if the EU and the individual EU nations themselves decide that departures from the EU and the single currency are required, then quite clearly you get the old argument of an impaired monetary unit, and that being clearly a negative for the euro. When you get two options, you either completely abandon the euro itself if you have more than one nation seeking to exit, or if you only have one or maybe two peripheral nations that can't pay their debts and seeking to exit, then you get a two-stage euro, one which covers the peripheral nations, which would remain quite weak because they need devaluations in their currency to offset austerity, and the other would be made up of the stronger nations, which are primarily the AAA nations surrounding Germany, and they would have a much stronger currency in that environment if you do get a separated one. So the interesting thing is that for the Germans and the other AAA-rated nations, it's actually in their interest to keep the peripheral nations in the Union, simply because it will continue to depress their own currencies rather than strengthen them.
How do you think predictions of a US employment slowdown will influence the pound dollar?
I think the logical conclusion of this scenario is that the US dollar continues to strengthen, and that occurs not just against the euro but also against the pound. So, while I think 157 to 162 is a broad resistance level for the pound on the top side, our scenario would be for a continued decline in the pound down towards that 145 to 135 as well over the medium term. The UK continues to struggle from an economic point of view, independently of the EU. However, the EU issues are significant. If we have a scenario for further and greater or more deep declines in EU growth, then the UK, being the largest trading partner of the EU, will also start to suffer as well. So, we'd expect continued negative periods or quarters of negative growth, and at the same time, continued declines in UK yields relative to US. So that will continue to undermine the pound.
What are your short, mid and long-term predictions for the dollar yen?
Dollar yen, we have a relatively stable scenario because the assumption is that the Bank of Japan and the Ministry of Finance will continue to support the dollar and try and weaken the yen around the 75 yen level to the dollar. So we continue to expect a relatively range-bound profile over the course of the next 3 to 6 months, somewhere between 75 and 80. Longer term, it remains possible for the dollar yen to break 75 and head towards 65 to 70, but in this environment of a stronger US dollar, it's unlikely to see that occur. So in the 3 to 6 to 12 months window, we tend to think we'll continue to see relatively range-bound action.
Which pairing has the most risk in your opinion?
We tend to think that the commodity and high-yielding emerging market currencies are most at risk. If the assumption is that the growth slowing actually worsens and commodity prices continue to fall, then those are the currencies that will be most at risk.
Thanks for joining me, Craig. Well, that's all we've got time for right now. Stay tuned to Dukascopy TV for more updates and interviews. For now, though, goodbye.